I do not hold any international stocks or ETFs in my portfolio yet. This decision has allowed my portfolio to grow by an additional 6 figures in the past decade alone. But unlike the absence of bonds, it is not a permanent part of my strategy moving forward. In this video, we'll dive deep into the history of the performance difference of US and international stocks. I will provide my reasons for the omission of international exposure in my current portfolio and why I think that will change further down the road. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please slaughter the like button, subscribe if you haven't already, and drop me a comment down below with your thoughts about the international market. It's time to quickly throw in my plugs. If you or a friend is interested in Seeking Alpha Premium, the best site on the internet to research stocks and ETFs, I have a link below that will save you at least 20% on your first year. I also have an Amazon storefront that shows all the books that this nerd has been reading, if you're interested in that as well. You know what time it is. Oh, and yeah, that, and also let's grow. Love stocks, dislike bonds. Before we jump into comparing international and US stocks, I wanted to quickly touch on the differences between stocks and bonds in general. And I'll keep this part short because I recently made a full video on why I don't hold bonds in my portfolio, but I just want to cover the basics again because I think it will be good context before we dive into the location of where we're investing. Holding stocks represents ownership in a company. You are directly tied to the future results. Bonds allow you to loan the company or the government money, which pays you a set amount of interest over an agreed upon amount of time. Stocks are more volatile. They'll have higher highs and lower lows. But over long periods of time, even for the cherry-picking data folks among us, stocks have been superior for more than a century. And it's not even close, but more importantly, it's not random. The core differences will remain intact long-term, with the reversion of the mean being inevitable. I go into more detail on the other video that I made, and I'll link it in the description below, but I just wanted to touch on the basics before diving into more data for this topic. Comparing stocks to bonds is apples to oranges. Comparing US stocks to international stocks is apples to apples. I like apples better, and I may try some of the different varieties over the years. I will be referring exclusively to stocks for the remainder of this video. The US market. I would love to tell you that I'm perfectly objective across the board, but I'd be lying. We all have our natural biases built in, it's just human nature. I was born and raised in the United States of America. Of course, I'm going to have a built-in preference for holding US stocks and ETFs. I say this because we need to be careful about letting our biases blind us to what's happening in the world. That said, the US market has been a dominant force for many decades. It has been the most surefire way to build stable wealth over the years. Our capitalist economy rewards entrepreneurs for being innovative and finding better ways to do things. This free market naturally increases the profits for companies that continue to push the limit. We can invest in these companies to gain our fair share of the profits. And we get exposure to international business just by holding US companies. The S&P 500 index, which holds 500 of the largest companies in the United States, gets 41% of its aggregate revenue from international markets. This doesn't mean that the US markets are risk-free by any stretch. Having all of our investments in the US comes with risk, and we'll get into some of that later. But for now, it's time to get into the data. US stocks versus international stocks since 1986 via a backtest. I was able to pull nearly 40 years of data by using the asset class backtest on Portfolio Visualizer. We're going to see that the United States has been on a massive run of dominance over the last decade, but the international market had quite a few streaks of its own before that. Let's dive in. We are out on Portfolio Visualizer, and we're going to take a look at the asset class backtest. So I have 3 portfolios here that we'll be looking at. The portfolio 1 is total international market. It's basically the world market minus, so X, the US. And then portfolio 2 is the exact opposite, the US stock market minus the world. And then portfolio 3 is US large cap, which is VU, and the total US market is VTI. And I've tested these against the asset class, and they're like a couple bucks different, so they're basically spot on. So we're essentially looking at international versus VTI versus VU. And you can see that the portfolios are set up accordingly, portfolio 1, portfolio 2, and portfolio 3 down here. And then for the parameters, we are going to be looking from 1986 to 2024. So that's nearly 39 years of data. That's the furthest I could go back on this back test for the asset classes, including year to date. So 2024 so far is there. We're starting with $5,000, pretty reasonable, pretty low amount, and contributing $500 per month. And I think that's it. So I am going to hit Analyze Portfolios. We're going to start here at the annual returns. I'm going to show the results that I usually show first with the final numbers at the end this time, just to keep a little more suspense going, and I think you'll be blown away. So you can see that international, ex-US is the blue dot, VTI is the green, that's our total market, and then here's where I live more, the gray one, which is the S&P 500. International got a blazing start in 1986. It was way up. That's wild. 63%. And I won't read all these, but you can see international got off to quite the start in the first few years here. And then US took over and international had a rough one. But then the US kind of dominates for a while. And the point I want to make here is it tends to go in streaks. See, international gets a couple W's and then it falls well short for a while until it doesn't. It starts to win again here in 2002 and it goes on a dominant run for 6 years. They trend mostly together like you would expect, but there isn't always positive correlation like this one here. But the main point of this year-by-year returns is that sometimes international dominates for a spurt of time, and sometimes the US will dominate for a while. So the winning streaks have bounced back and forth between the two. But it's a little deceptive. When you look at the trailing returns, and we know the United States has dominated recently. In the last 1 year, international's under 11%, whereas the US markets are both over 23. In the past 3 years of annualized returns, international is about flat, and VTI is up almost 8%, and S&P 500 is up about 10%. In the last 5 years, international's under 6%, and the other two are sniffing or over 14%. And then a nice 10-year chunk, and again, this isn't unexpected because we know it's been a US dominating run. We have international up 4%, the total market US up 12%, and the S&P 500 up 12.7%. And then the full nearly 39 years, nothing fluky about this. International is up 6.75%, VTI is 10.78, and the S&P 500 is up over 11% per year. Okay, and now for the performance summary, which I saved for the end. I think this will blow you away. We started with 5,000 and we put 500 in per month. If you rolled entirely with the international, you would be at $775,000 after 39 years. With VTI, you would be at 2.9 million. And with the S&P 500, you would be at 3,071,000. And so you can see these 5 or 6% returns versus the 10 versus the 10 and 11. It doesn't look like much on paper. It's sort of like when financial advisors charge us 1% and we think, oh, or an expense ratio is, 0.75 or 1. You're like, oh, it's only 1%. That's not much. And you're like, wait a minute. How does it take 40% of my portfolio over my investing career? It's one of those kind of things. Compound interest really is the eighth wonder of the world. And we can look at our best year. International went bonkers that year. But then on the worst year, it was down 44%. And the US market's a little more in the middle at 35 and negative 37 for VTI. And the best year for VU is 37.45 and the worst year is negative 37. And where's the standard deviation? You can see standard deviation you want lower for more consistent results, and our US market has a lower standard deviation. And then the Sharpe ratios you want higher for risk-adjusted returns. You can see that United States dominates that as well. The reversion to the mean is real. You'll hear people say that and they are 100% right. But when you invest over the long haul and you zoom out, the United States and our version of capitalism capitalism has been superior, period, to the international markets. This may not always be the case, but until something fundamentally changes, I'm putting my investments into the United States, and that gets me 40% of my revenues overseas anyway. Timing the market to get the best returns from the US market and the international market year by year is simply impossible. We would all be billionaires if we knew exactly when each rotation would happen. I'll be sticking with US ETFs to grow the most stable wealth. For now. Never say never. Nobody knows what the market is going to do in the future. I'm a believer in holding the assets with the best long-term track record. And by long-term, I mean long-term, with multiple cycles and reversions built in. It's also important to note that I hold and buy them even during the bad times, especially during the bad times. I'm not a fan of holding bonds, for example, to protect me in those years that the S&P 500 drops. They consistently stifle returns for dollar cost averaging buy and hold investors over any 20, 50, or 100-year stretch that you can handpick from the past. But you can only use that logic if you don't panic sell when times get rough. If you don't trust yourself to stay the course in hard times, and there's nothing wrong with that, bonds can be a great hedge for your portfolio. I mentioned earlier that the S&P 500 receives 41%, that's sniffing almost half of its aggregate revenue from international markets. This does not protect us if core changes happen directly to the US economy. I'm nearly certain that I will get exposure to international markets as the world we live in changes. The dominance of international stocks during those streaks in the past tend to happen for multiple years in a row. It's not just a random one and done type thing. I'll likely be late to the party for the next one. But I will jump on board as long as the results are based on sustainable underlying financials. I'm happy with the international exposure that I receive from my US holdings currently. And I have outperformed VT, the total world market, which is about 60% US and 40% international, by about $558,000 over my investing career. So far, my decisions have paid off. I don't assume that any one country will be on top of the food chain forever. But I also don't believe in jumping everywhere based on random predictions of when something will happen in the future. I'll wait until concrete data guides me. And speaking of top of the food chain, we had 4 new members this week. A huge shout out to Chris, Dan, Vizad, and Peter. I appreciate you signing up for the channel membership, it means a lot. I hope you enjoy the badges, the emotes, comment priority, and the nerdy spreadsheets. I really do appreciate the support from the new and the old members out there. This community really is awesome. And check out one of these 2 videos if you want to continue down that path towards your version of financial freedom. Thanks for watching, and I will see you here next Sunday. Peace.